Thanks everyone for coming. Jonah, I'm going to say it now. And we're live with another, we're still getting people coming in, but we are live with another fantastic entrepreneur education session. We are in Summit 7 of Startup TNT, where, we have companies we were notified last night of top 10 or not. We don't announce top 10 publicly, but we are moving through the due diligence process towards our top 5 finale on June 15th. And we have a lot of participating entrepreneurs here in the room with us today for a very special session on financial modeling, given by one of our best friend sponsors, our newest best friend sponsor, MNP, and specifically Nick Wayman, partner of external and financial advisory at MNP in their Edmonton office. Nick, why don't you introduce yourself really quickly here?
Yeah, great. Thanks everyone for joining today. So my name is Nick Wayman. I'm a partner in our external financial advisory practice here in Edmonton. I also lead the practice here for the Edmonton region. What we do to serve clients really is we do fractional CFO services. So what that entails a lot of the time when working with startups, obviously, is looking at financial modeling, reporting, thinking through all the considerations there around how do we structure our accounting to report to stakeholders or investors. So really kind of a full spectrum there. Yeah, that's a little bit of me. I've been doing this within MNP for about 5 years. Before that, I was in audit, and then I worked out in industry for a few years. So I've been on kind of both sides of accounting firms and also working out in industry. So I have that perspective of looking at things through both lenses.
Okay, cool. Thanks a lot, Nick. And so I'll introduce myself really quickly. So I'm Adrian. Normally these sessions are given by Jesse, our Saskatchewan lead extraordinaire, but today you get me. I'm the partnerships lead, head of growth at TNT. I've been an investor with TNT for, I think this is my 7th or 8th summit now. I was a former startup co-founder myself, so know what a lot of the founders are going through. So I'm sure we're going to have lots of fantastic questions. Financial modeling is one of those things that every startup has to do, and we have all the. I think, Nick, what we're really looking forward to hearing some sort of tips, tricks, advice, rules of thumbs, things that you've got for the startups. Maybe just start like in your practice right now at MNP. I know you guys have a tech focus and you're working with startups, and it's part of why we have this partnership together. Can you just give us a breakdown of sort of what your practice looks like from on the company side?
Yeah, for sure. So within our group, we work with clients that are both on that startup side of the spectrum and also mature companies. So myself personally, we work with clients kind of at all stages in their life cycle. Specifically looking at Edmonton and looking at Canada, like we're seeing a lot of really good buzz around technology in Canada. A lot of support, a lot of investors looking to put in some capital into some really cool ideas and initiatives. A lot of government support as well. A lot of grants are out there that can be tapped into as well, which provide a good amount of capital to start getting some of these companies off the ground and really move them towards getting products developed and out to market. So us, obviously as a firm, we want to focus on supporting and investing in that industry a little bit. That's kind of where our partnership comes from. We want to make sure that we're there to support these companies as they grow and scale. It's a great group to work with. I love working with these startups, the entrepreneurs, the ideas that you guys have, and looking at modeling. It's one of those things where what we aim to really do is take that vision that's in your head and sort of where do we think this technology could go or this business could go, and really just sort of take the data out of your brain and put it down into a template where we can look at it and say, well, what is it going to cost us to get there? Where's the money going to come from? Who's going to fund it? What are we going to spend it on? Right. And obviously there's a number of different reasons of why that's really important, which we'll get into in the presentation. But yeah, our practice is we work with companies pre-revenue, we work with companies that are scaling, we work with SaaS companies. So it's really full spectrum, right? And sometimes we're there for the whole ride, right? From pre-revenue into starting to get revenue, starting to scale that revenue as well. Again, we're looking to jump in and support where there's oftentimes a lot of support needed in those early days, right? Entrepreneurs aren't always accountants, for good reason. We work within a framework of rules and guidelines. So sometimes that perspective is something that we see a lot of value in.
Yeah, well, and one of the things I love about startups, why I support them and love doing so, is the innovation, the creativity, so that sometimes the game-changing. Sometimes it's just like small innovation tweaks and improvements, and sometimes it's game-changing technology and ideas that are really going to change things. And in those situations, often there's no predicate or precedent to sort of follow. Like, how do I model this? And I think it really is something that is often learned through doing, right? So I know you've got a 30 or so minute presentation here. How do you feel about people coming off mute and asking questions or putting questions in the chat during that presentation? Are you good with that?
Yeah, go ahead. One thing I'll see,
Cool.
Adrian, if I don't see a question in the chat, just let me know and I'll open it up.
I have the chat open, so I'll be happy to, if someone puts a question in there, maybe DM me if you're okay coming off mute. If you don't want to come off mute, if you don't tell me you don't, I may just say, okay, we got a question from, and I'll direct the question that way. Okay, and with that, Nick, I guess let's get going.
Awesome. Let's dive in. I'm just getting my screen share sorted out. Can everyone see that?
All good here.
All right. Awesome. So introduction, we've kind of covered that. So the first thing I'll kind of dive into here is when you look at forecasting, right? So if you look at a mature company, a lot of times what we do is we start with accrual basis accounting, right? So a lot of folks will sort of say, well, what is accrual basis accounting versus cash basis accounting? And accrual basis accounting really is looking at, okay, when did the transaction actually occur, right? So let's say, you ordered something and the invoice came out and it was dated May 31st. We put it into the accounting system. It's a May transaction from the accrual standpoint. From a cash standpoint, that invoice might get paid in June, right? So we look at it kind of more focusing, especially in the startup realm of things, we focus more on sort of what the cash timing of those transactions will be. So for startups, we definitely focus more so on the cash basis side of things, right? So just a little bit of terminology there. A lot of times what we do when we do build a financial forecast and financial model is we actually start with accrual basis assumptions. Sometimes it's easy to wrap our heads around, okay, well, this invoice is going to come in, it's for services that we did in April. And then what we do to kind of translate that and bridge the gaps is, okay, we'll say, when's the cash impact going to be of that specific transaction? So yeah, just a quick kind of terminology there. So moving on to sort of the purpose of a financial model. So obviously looking at, what goes into a data room, obviously is one side of that coin, but looking at kind of the other uses and stakeholders that are involved in looking at a model as you go. I've kind of built this little visual here to kind of show that, whatever you sort of put out there and develop as a core financial model really has a number of different uses and benefits that we can actually take it to take it and use it for. So if I kind of run around the circle here, right, looking at founders, right, so the folks that are actually getting into the business, right, what you want to look at when you do a financial model is, okay, well, what are we developing here? What are we building? What's our minimum viable product? What do we want to achieve in terms of milestones, right? Where do we want to get the technology or whatever it is that we're building to by a certain point in time? And really, what's it going to cost us, right? So from a founder's perspective, you're looking at that and saying, well, my vision now, my concept for what this business is going to be, here's what it looks like when we translate that down to cash, and what funding do we need, and how is it going to be deployed, and really is impactful from that standpoint for the founders. Looking at management as well. So again, when you kind of look at an org chart, early days, you've got the initial founders, you make some key hiring decisions. Eventually, as you grow, your team starts to become maybe more project focused or team focused, right? So when you think about that perspective as well, management obviously is a key stake in what the forecast looks like. When you say, okay, well, our R&D team, for example, okay, out of our total funding that we receive, what are we going to allocate to the R&D side of things? So that's where management has that insight to gain from our financial model. It sort of helps define a bit of a budget, right? Our R&D budget is going to be X, and this is how it's going to be deployed. So that's kind of how management. So again, we're kind of going down the levels of granularity here, right? So founders want to focus on the details. Management wants to look at, okay, high level, what do we want to work with? What are our key hires going to be? What contractors do we need to bring in? What are we going to spend in terms of getting some of this funding deployed and moving towards achieving some of those milestones and some of those project ends? Investors, right? So investors also really have a strong, need to understand really what do the numbers look like? Where's the money going to actually be spent? What's our use of funds for what we put into this company? Oftentimes in a data room, right, there will be a financial projection that says, okay, we're looking to raise this much money. Here's how it's going to be deployed. And then from our perspective, simplicity is kind of the key thing there when it comes to what goes to the investors. So they really want to look at, okay, well, if you're going to raise $1 million, how is that $1 million going to be allocated out? Who's going to, is it going to be employees? Is it going to be contractors? Is it going to be devices, machinery, equipment? They want to know where that money is going to go, and they want to know what's the achievement going to be with that specific fundraise, right? So I'll kind of get into it a bit later on, but we often approach fundraising in terms of tranches based on a milestone date, right? So you look at, from A to B. B includes a certain set of milestones with the technology that you have. you kind of fundraise against those milestones. Those milestones also drive value, right? So you kind of show to the investors what's that sort of value creation timeline look like over a long period of time. Advisors, so thinking about board of directors, audit committees, those kinds of things, they want to see this information as well. As you build out your board, maybe you've already got boards in place, you've got audit committees in place. It's really key to start thinking, okay, strategically, how do we want to raise our funds? Where do we want to go? What do we want to do in terms of a total raise? Do we want to push for milestone A and B with this one fundraise and strike while the iron is hot? If you're raising some funds and things are going well in the round, you might want to capitalize and say, well, do we want to oversubscribe so that we can move into milestone B as well as milestone A? So your advisors, your board members, your audit committee members, everyone really wants to have a bit of a perspective as to where's the money going to go. And a lot of times in board meetings that we sit in startups, what we see there is a very defined aspect of the presentation that focuses on what do we have today in the bank, what's our forecast to spend over the next period of time, and when are we going to be out of money, right? How's our runway doing? When are we on track both from a timeline perspective, and are we also on track from a cost perspective, right? So again, it's sort of looking at the granularity detail, right? We want to make sure that information does get to your advisory group. And then non-dilutive funders, thinking about some of those grants. So when you think about grants that will fund a specific initiative within R&D, let's say there's provincial granting agencies that want to fund you towards, let's say, commercialization of technology. A lot of times they'll ask for projections, right? They want to know, okay, well, if we do allocate some non-dilutive, non-repayable grant money into this company, what's the value proposition for that investment that say some of those non-dilutive funders are going to make? So we've seen it in the past where to access a certain grant, let's say with Alberta Innovates here in Alberta, they've asked for 7-year projections that include a full commercialized set of financial statements, right? So what's the revenue going to look like? What's the margin going to look like? What's the bottom line going to look like? And it's all pie in the sky at this point in time. And the one thing I'll kind of stress with all of this, right, is you're never going to be correct in your forecast, right? It's never going to be 100%. This is what's going to transpire, but it's the best estimate, best guess that we have today. To sort of say this is what a potential business case for this company, technology, or whatever it could be looks like down the road, right?
Yeah, that's cool. That's a pretty comprehensive summary. That's great.
Yeah, so I always like to think about it this way, right? You kind of build that model one time. We don't sort of build it for when it's needed and who needs it. You have that one kind of core functional model, and then what you do is you kind of design how the outputs look, right? So management wants to look at the detail. Advisors want to look at it really summarized and really concise and condensed. And investors want to probably see kind of a bit of both, right? Pitch deck, typically you have one slide that says this is our revenue projection, this is our bottom line projection, or this is our use of funds in 3 or 4 rows, and keeps it really, really concise. But obviously when you get through the process of doing some of the due diligence and people want to look at things, they might want to look at your model and say, well, specifically, how is this going to be allocated out, right? What hires are you going to be making? What's the technology like? What's the R&D aspect going to be? What's that budget look like? So from that perspective, having one centralized model kind of fits with knocking all these different requirements off your list. All right, so as we touched on, there's kind of a granularity spectrum here when it comes to looking at your forecast, right? You want to basically be able to focus on the details at a management level, right? Management, we want to look at it and we want to say, okay, we've engaged a specific consultant to do a study for us, and it's going to happen in July of 2023. What are they currently quoting us to what's it going to cost us at the end of the day, right? If you want to look at the details, okay, what do we need to do salary adjustments? What are the positions that we have currently vacant that we need to fill? And really, what's it going to cost? So in the model itself, what we end up doing is we kind of have this sort of spectrum where we've got the schedules that have all the detail, and we've got the outputs that contain the really concise, summarized information. And this is kind of that spectrum, right? Higher detail on the management side of things, lower detail on the stakeholder side of things, like investors and advisors. So in terms of kind of getting into the process of actually building out your financial model, these are some of the questions that oftentimes will come up at the very beginning in terms of setting the stage as to what we want to build, what scenarios we want to model. And I'll kind of go into all of these here. So know where to focus your use of funds. We work with companies that are really looking at building to sell IP, right? So on that one spectrum, really, they're an R&D company. They don't really expect to get to revenue. What they do expect to is to sell to a strategic investor or potentially someone that would acquire that technology and roll it into their existing platform. That's a very different set of assumptions, when you compare it to actually going to commercialization, for example. We have clients where they're building SaaS, right? Software as a service. And so for them, it's different because those costs are going to be involved much more so in like the marketing and much more in the branding and the advertising and getting actual customers, right? So I always kind of say at the very beginning, this happens a lot of times when I work with early stage companies. It's like, well, we don't really know yet if we might want to get acquired. Maybe there's an exit opportunity in the future. Or, do we take this thing fully out there and commercialize it and start to generate revenue? And I always say, I think it's good to sort of think through what do you actually intend to do, because you've got a finite amount of cash and resources to deploy, right? So oftentimes it's kind of bridging the gap between what do your investors see the opportunity as and what do you see the opportunity as, and sort of finding ways to kind of pair those two together. A lot of times, we have a scenario A and a scenario B and a scenario C. And the scenario C in that particular example might be, let's assume we don't get an acquisition when we expect to get an acquisition. We go to Series A, we're looking at getting some ramp up in terms of funding to really go after commercialization. Does that change anything in terms of what we're working on today, right? So, and if it does, what would be that sort of divergent point in time where we would say, okay, now it's time to start thinking about focusing on that commercialization plan. So I always like to say it's a good idea to sort of model out both scenarios, right? If you're planning to build the sell, what is it going to cost you to get there? What do your investors want to see? But it's always good to have that backup plan in mind to say, well, if we had to pivot, and this happens all the time, right? Things are never really as static or as simple as you think at the beginning. But if we had to pivot, how do we actually pivot and show that in the model and start to think about what a Series A could look like as an example?
Yeah, so
Right.
that scenario, maybe we could talk about that a little bit. Having that scenario functionality in a model can obviously add complexity to your model, but you're saying that's sort of a critical component here.
Yeah, absolutely, definitely. Scenarios are a big one, right? And it can present some challenges sometimes when sometimes some of your investors might require that they receive a copy of your approved budget. I always find that to be a funny thing in a startup, especially when you're pre-revenue. It's like, okay, what's our approved budget? You know what I mean? We don't really know what's going to happen in the next 12 months. So really what it is we've taken one potential scenario and we say, this is kind of what we think is the most likely outcome. Let's approve this budget, get it out there. But realistically, from a management standpoint, we're looking at scenario B and scenario C and saying, well, any one of these could happen. We might raise more than we thought. We might want to oversubscribe. We might want to accelerate timelines on a certain milestone that we were planning to do later, for various reasons. And so it's definitely good to have those scenarios. I think as you build it out too as well, it's important to know where's the cash going to come from. We have clients that are startups that have been primarily funded through non-dilutive funding, right? So there are some programs out there that will actually lend against this. If let's say the timeline to commercialization is shorter, we can get to revenue generation sooner. That might shift you in the spectrum in terms of high risk to low risk in terms of where you can access your money. Right, so it's looking at what are available for grants out there. We're looking at salary grants, we're looking at R&D grants, we're looking at traditional lending, or we're looking at investment, right? And we're looking at bringing investors into the cap table. So I think it's a good idea to sort of, as you build this model out, where's the cash going to come from? Because that again dictates many different things, right? You might strategically raise an amount of money to manage dilution on your cap table, which is your capitalization table, which kind of shows who owns the shares. And sometimes we see a lot more now convertible instruments like safe notes and convertible notes as well. So you see a lot of those kind of add to the cap table. It's important to sort of manage dilution as well early stage when your valuation is lower. So sometimes looking at the combination between what do we expect to be able to raise from a grant funding perspective, what do we expect to be able to raise from an investment perspective, and really kind of balancing those two together, right? Obviously the focus and emphasis, I think in early days, is really to manage dilution to the extent they possibly can. Yeah. Business plan. So this is kind of a big one. A lot of folks when we first meet them, they'll have sometimes they'll have a business plan put together, Google business plan, download it a Word document and sort of edit it to sort of include the vision and mission and all of the associated assumptions and the description of the technology and the value proposition plan. Sometimes we see clients that don't really have that yet, and the reason why I put that here is something that's key is it's a really good exercise to go through because it kind of prompts you to think about everything that you're planning to do and start to consider market implications, start to consider, what do we think, what do we expect in terms of staffing? Are we going to be able to access our staff in this region that we're in? Are we going to be able to access grant funding, provincially? What's really going to be that kind of core driving thesis for your business? And I always like to say, you should have something like that in place, because then what you really do is you kind of pair your model up with your business plan, right? So whatever you've got included in that document, realistically is something that you'd want to be tracking and managing against as you go into the future. And again, they don't have to be overly extensive. It's a good exercise to go through because it kind of prompts you to think about all these different aspects of what your business could be. The next one there is milestones. So a lot of times what we do is, you pair up this financial model. Oftentimes you want to put out there a bit of a Gantt chart, right? So if we have a milestone that we want to achieve and it's minimum viable product, let's say it's a SaaS product and we're looking at getting kind of base functionality out to market. We think it's going to be, the highest return to get that out to market sooner. If that's your milestone, a lot of times what we see is that's a fundable, aspect of your business, right? So our plan is to get MVP to market by Q4 of 2023. What you can do then is sort of reverse engineer what needs to be incurred in terms of cost, developer time, labor, contractors, consultants, materials, all of those associated expenses to support that milestone. A lot of times what we do in financial models is we actually sort of have it where when you think about the longer term, you kind of look at it, we've got a raise, we've got cash burn, we've got a milestone completion, and then we have a raise that has to take place to kind of start thinking about the next one, right? And it's all about being proactive. So we kind of track that milestone like it's sort of what we funded at that time, and if we get it done, we can then take that and justify a higher valuation at the next fundraise and avoid, a down round. We look at how do we build the most value to keep the value climbing over time.
So we have a question from Jay in the chat. Jay, do you want to come off mute and ask your question?
Sure. Hey guys. So my question is, when building out a business plan, do you recommend scenario-based financials, such as scenario A being bootstrap, scenario B being with government funding that you're currently applying for, and then scenario C being with investment built in? Because right now my big challenge is trying to articulate, even though it seems like it would be a simple concept, trying to articulate the fact that my bootstrap financials are where we're at now, and adding in investment funding would simply move all my timelines up.
Yeah, absolutely. A business plan, it's something where you can definitely make scenarios into a business plan. I think it's important to show that if you provide that, let's say, to investors as part of your data room, they'll want to see how that investment is going to drive those accelerated timelines, right? For them, they want to get their money in and they want to get it out as soon as they possibly can, right? So having that scenario in there definitely supports that. Yeah, so I recommend in your business plan, within reason, right? This is kind of what we would do with scenario A. This is what we do within scenario B, and it can support that sort of scenario B scenario where you can help investors sort of see that value creation as a shorter timeline.
Okay, perfect. Thanks.
Yeah. Awesome. Know your KPIs and track them. This is a big one. So I had a really good analogy just recently here where kind of this exercise in cash flow forecasting and forecasting is kind of like, it's kind of like flossing your teeth, right? Everyone knows that you should do it all the time, but do we all do it every single day, 2 times a day? Probably not. It's one of those things where everyone knows you got to do it, right? So with cash flow forecasting, it's one of those things where we don't really want to set it and forget it, right? It's especially in a startup, it just doesn't work that way. Maybe if you're running a parking lot, for example, where it's pretty stable revenues and it's very stable expenses, it probably requires less ongoing attention. But in a startup, things change constantly. We expected to engage a contracted engineering firm in July of 2023. Discussions and yada, yada, yada led to that happening now in October. We want to make sure that's reflected in the forecast so that we know, are we still good realistically in terms of cash burn and runway? So it's about monitoring, it's about updating, it's about revisiting it when things change, and tracking those KPIs, which we'll get to in a little bit here once I bring up that slide. Planning ahead. So one of the real key benefits of modeling, right, is again, when you think about dilution and think about value and how you kind of step your value over time, a soft circle, right? So I'm sure a lot of folks are familiar with that term, right? It sort of means, yeah, we've talked to some investors and they've loosely indicated that they might be putting in some cash, and here's kind of roughly what we think that might be. I've seen it take 6 months to get a soft circle to cash in the bank account, right? So planning ahead where you think about it, say, well, milestone A, we have expectations around cash running out in April or May of 2025. Realistically, you're starting to raise the funds that you need for milestone B 6 months before you're even done completing scenario A. Because if it comes down to it, right, you want to make sure that there's time for that cash to come in. Obviously, at that time, you've got to make sure your technology is at a point where you can kind of justify some of those valuations that are hopefully climbing, and again, to manage dilution. But one of the benefits and perks of going through the exercise of forecasting is really being able to start thinking about, okay, well, we are going to be out of money in April 2025. We got to start raising funds in October, November, December of 2024, so that we can have commitments and we can have cash in the bank account by the time that we really need it. And get into the weeds, right? So it really comes down to detail. Again, it's like that flossing thing, right? We don't want to, we got to do it. We got to get into the weeds. It's maybe uncomfortable at first if you haven't done it in a few months. So you got to get into it and really start thinking through, okay, what is it actually going to cost? What positions do we need? What consultants do we need to engage? What devices, what equipment do we need to purchase? What do we need to actually spend our money on, and have it be really detailed? We've seen, clients in the past where we would have sort of, okay, well, we think we're going to roughly have, 20 grand of contractor expenses, over the summer. And then we kind of get into it, start to track our KPIs, report, monitor monthly. And we look at that $20,000 and say, well, what actually did that cover? What was that actually going to entail? Like, what specific contractors do we actually need to bring in to support the development of what we're working on? So for that purpose, right, I like to go with schedules, right? Detailed schedules that show here's exactly what we need to spend, and here's exactly what's going to be spent on. We've talked to the supplier, we've done some research, we figured out exactly what that cost is going to be, and we put that into the model. Again, like I said, you're never going to be correct on this. It's never going to be right. There's always going to be things that will go differently from what you expect, but at least it sort of puts a good estimate out there that we can revisit and we can use it to make some data-driven decisions. And buffer's a big one. So we're not all oracles here. We can't see into the future. Experiences with project management, with change management, with anything really, and building a business is things are going to go sideways, right? Things are going to take longer than you thought. Things are going to, overrun in cost. We might miss MVP date by month or 2 months or 3. So really what it comes down to is having a good, healthy buffer is also vital. So when I go back to that point about reverse engineering what it is to get to where you need to get to. If you're out of cash in April 2025, realistically, from a company perspective, we're planning to be completed that milestone in 6 months prior. So looking at November of 2024, right? That's that plan, and we've got that cash flow buffer there to make sure that we can account for some of those overages, right? So we actually get in the weeds with some of our clients. We actually do a buffer in the monthly cash flow forecast. We say, here's all what we thought we would spend, and 10-15% above that is kind of what we probably will spend. Right, so these things just happen.
Man, there's a lot on this slide. You covered a lot of good stuff. At the risk of going long, I mean, I'd say there's so many like cliches or slogans, right? If you don't plan to fail, right? If you how do you know if you're doing well if you don't measure it or KPIs, right? Like the buffer one's interesting. Like I've worked at large corporations where we would add like a capital cost. Sort of miscellaneous, like 15%, and that was organizations with 2 decades of experience executing things, and we would still add 15% on our AFPs and our PARs. So that buffer, I mean that's something for people to think about. Like things can take longer, costs can go up, for sure. And then I guess one thing I will ask your take. We investors say it and startup founders say it. Like forecasts they're kind of garbage, right? They're kind of like it's no good, but we need to do them. Like there's value in them, right? Like at least have some idea. What do you think there?
Yeah, absolutely. I mean, if you ask an investor in an early stage company, like, hey, what did you invest in? A lot of times they'll say, well, the management team is who we invested in, right? We believe their idea is good, and we think that this management team can execute on that plan. That said, any investor that's willing to put money in without looking at where's the money going to go and how is it going to be spent and how much cash is going to be required, that's going to be something that might be a bit of a sticking point, right? Again, it kind of shows this is roughly where we've gone through the exercise now of planning, and that's a lot of times what they want to see. They want to say, okay, have you actually taken the time to sit down and think about where is it actually going to go? How's it going to be deployed? What's the time going to look like? How much runway does it give you? They want to make sure that you've done that exercise more so than put the weight on the numbers themselves specifically, right? If it ends up being a plus minus of 50% between employees and contractors and you had to buy more materials and you thought, again, it's not going to, if it's kind of transferring from one to the other, they don't really care about the classification of it. Just where's the technology going to go? Can you do it? Have you kind of thought it through in terms of what you're looking to raise and where you're going to get to at the end of the day? Yeah. All right, so so the next slide here is kind of just sort of key takeaways in terms of what your model should look like at the end of the day, right? So as we've been touching on here, scenarios definitely are really, really important. The first thing here is really you want it to be dynamic and you want it to be easy to edit. You know, we've you know, in the past and in other situations, we've built models that are incredibly complicated to sort of manage and to update. You know, in my prior experiences, while I've done financial modeling for a commodities company, where your price literally changes every second of every single day, right? So it becomes really difficult to actually say, well, this is kind of what we're going to base it on. But as things change, and especially in the startup space, right, you need to build this model in a way where you can go in and quickly make those edits and changes. If it's too cumbersome to go in and make changes, you know, yeah, human tendency is to just avoid, right? if it's too difficult. So really making it easy to set up, making sure that you've labeled everything that you've got in the model. Again, going back to the contractor example, if you just have this sort of $20,000 blanket contractor spend category, we want to go in and say, well, five of that's going to be for this human resources contractor, and 5,000 of this is going to be for this research and development contractor, right? So you want to be able to get specific, and so that when things change, so you get a quote from a supplier that you kind of loosely been discussing a project with, and they come back and say, well, here's what the cost is going to be, and if it's higher, let's say it went from 20 to 40,000. We want to make sure that we can plug that into the model quickly and see what's that impact going to be to our overall cash. So that's definitely a key one, right? Is kind of making sure that we can keep tabs on all of this. Be detailed. So definitely I've touched on that already. So really just ensuring that you know, we're adding all the detail that we need to add to the model, right? And again, it's happened before where we've gone into meetings and we sort of have questions coming in from board members or you know, management saying, well, what was this budget for again? We don't want to be in that situation. We want to know exactly where that cash is going and what it's going to be used for. Thinking to the future. So I always think about, you know, cash flow forecasting. I can be pretty dialed in for let's say, you know, we're at May 18th right now. I can be pretty dialed in right now, probably till June 30th. July is getting a bit murky. August is getting murkier still. And if you go out a year, I mean, who really knows, right? But we do see granting agencies in particular. You know, we had a request come in for a startup from a granting agency where they wanted a 7-year projection for a startup that's been incorporated since 2020. I'm like, are you kidding me? Like, what do you expect us to put together here? And that's kind of where we went to that, you know, go back to that wheel, right? They just want to sort of say that you've sat down and thought about what could the commercial abilities and the economic impact of this company be if you commercialize it, if you scale it. What does the market look like? Again, they want to sort of see that you put the thought into thinking through some of those assumptions. Again, I would, you know, if I go and take that forecast that we did in 2021 for 7 years and I go to 2028, and let's say we do a budget to actuals comparison in 2028, you know, we'll probably be off by thousands of %, right? But again, it's having that sort of ability to kind of put it together and think through long term, what could it do? And I like having this on deck, right? So just having a longer term forecast on deck is just a good thing to have. Because again, you don't want to have the scramble of, oh, we have to get this application right away. We need to have a 7-year projection put together. You know, it's good if it's already kind of existing and you just have to run a couple updates and then, you know, send it out to whoever's putting in some of the cash. Tracking results and monitoring monthly. This is a big one. So Adrian touched on that as well, right? It's one of those things where you want to make sure that you're revisiting what you've put together every single month. So in clients that we work with and we look at modeling, we have a number of different KPIs, right? We look at what our expected burn was for the month compared to what our actual cash burn was for the month. We look at what our expected bank balance was for the month versus what our actual bank balance was for the month. And why that's really important is it tells you where some of those gaps were when you put together your forecast to what actually ended up transpiring, right? Did we have we had a certain expenditure that we weren't actually forecasting for. That's the bad one. It's a cash unfavorable thing, right? So we want to make sure that we're monitoring how we do it as we go, and every month we should know, okay, what's the impact to our runway? What's the impact to our cash balance? Are we still on track? And just a few days ago, we had a meeting with the board of directors for a client, and they wanted it to kind of go full bore here and look at a Gantt chart, right? So we have these 3 projects that we're working on. We want to look at 2 different visuals. We want to look at one that is timeline. So that's a qualitative thing that comes from the project managers, the management team, and say, okay, from a timeline perspective, is the technology advancing as we expect it to be advancing? And then they said, we want to also look at it from a cost perspective, a cost timeline. So they wanted a dotted line to show what's our cost in this budget versus what we thought it would be. And those are really important KPIs for them, because the discussion that's going to come away from that is really going to be, well, do we need to look at project C and allocate some of that funding to project A? Because that's the main one that we're working on. That's going to drive the most amount of value for us. And that's the kind of conversation that they want to have. And that's what the financial model is really being used for.
That's super interesting. I mean, that's very operational board, right? Making that kind of judgment.
Yeah.
That not all boards are operational like that. So we had a question in the chat, which I think you answered, and I can certainly weigh in here, about data rooms and whether to he's hearing mixed reviews on including account balance screenshots in the data room. To me, that sounds like investors not trusting the cash, the claim that the startup's seeing. What's your take on that?
Yeah, I mean, for investors, I probably wouldn't get that granular. I've personally, we've helped a lot of clients build data rooms, and we've never put like a snapshot of the cash balance into the data room. Like I said, again, at this point in time, they're investing in the management team, they're investing in the concept, and they're investing how the management team is going to pair those 2 things together. I will say for board presentations, oftentimes we will do a snapshot of what we have in the bank account for the board meetings, because again, they want to kind of look at that sort of big picture. Are we on track? Do we have a certain amount of cash in the bank? And sometimes they kind of think about it bigger picture, right? Okay, we got this much money in the bank account. Okay, things are good. If it starts to kind of come down, they're going to have a bit more pressure and weight on that Gantt chart, right? But in the data room, generally speaking, we will have either a full version of the model, or we'll do a summarized version of it, where we kind of have this is the summary model that we have. This is kind of the key. And then if investors request the model, then we would actually provide it to them. But generally speaking, we keep the data pretty tight and pretty concise in the data room. Okay, so then, really the model, I look at it as a tool, especially in the early days where we're pre-revenue, we're starting to maybe get some revenue, maybe we're a SaaS company that's starting to get some sales. Likely what's going to end up happening though is we're not quite yet in a profitable position, so there's still going to be cash burn. So really what I think a really important use case of the model is that going back to that reverse engineering point, right, where we look at it and say, this tranche, this milestone, this is the fundraise to get that milestone completed. Once that milestone's been completed, we can then sort of re-go to market to raise more money, let's say, and we have something to show for it, right? We have a bit of a enterprise value creation by developing a certain technology that we want to then put out to market and say, well, okay, our valuation was X, now it's Y, here's what we're looking to raise. And I find that using the model to reverse engineer what the fundraise needs to look like is really, really key for that, right? So you'll have tranche A, we're looking to raise $1 million. That $1 million is going to get us to an MVP. Here's where it's going to be allocated, but you kind of, you don't approach it by saying, I want to raise $1 million, right? First off, you say, it's going to cost me $1 million to get this thing where I need it to get to. Now that's driving how I come up with that amount for the raise. So that's kind of that point there. Soft circle, we did talk about that, obviously, right? It takes a long time to close on investment funds. Run scenarios, right? So looking at scenarios is a really key thing to do, and it can add some cumbersome steps to the model. A lot of times, what we'll do is we'll just sort of have either parallel models that run different scenarios and then summarize them in a specific way, where we kind of have scenario A, scenario B. In some cases, we get really fancy and build in a scenario that says, okay, well, if we adjust, this is maybe more applicable for if it's generating revenues. If we just adjust our revenue assumptions by saying it's 25% less subscriptions or 25% more subscriptions, or whatever those parameters need to be, what will be the impact overall on the financial statement side of things? Yeah. And again, I've already touched on this point here too, but revisit that forecast often, right? It's one of those things where it's got to take kind of consistent management and monitoring, and it really forms kind of one of the most key documents and tools in terms of management outside of the technology, right? It's all comes down to cash, and do we have enough cash to get what we need to get done. All right, the next slide here is kind of looking at, where do we come up with these assumptions, right? So a lot of different ways that this information is pulled together. So if you're looking at raise funds, right? So again, we've done this reverse engineering process. Now what we're looking at here is saying, what do we think we could raise via a safe note, a convertible note, or potentially a direct subscription for some shares? Who's out there, right? Are there companies that you've been working with, investment firms that are looking at maybe being a bit more of a strategic partner to you guys? Lucy, what kind of discussions have you had with them in terms of what their willingness would be to invest a certain amount of capital? So you see a lot of different, you see that initial call or that initial meeting with, let's say, a potential investor, and they'll say, yeah, this technology seems good. I think we might be good for $1 million. That again, by the time it transpires to cash in the bank, it can be 500. It could be, so it's one of those things where you really got to know who the investors are and keep discussing with them, what their comfort level might be. And that helps kind of drive, okay, what's our capital structure going to be? What do we think we can raise from these folks? Should we be conservative and say, well, let's assume we get half of that from investors? Does that leave a cash flow gap in terms of where we will be over the next year? So knowing your investors, knowing where the money is going to come from is really, really key. Understanding the grants that are out there and available. There's a lot of good tools now, both kind of provincially and federally, that will summarize kind of grants that are available to companies that are funding various initiatives, right? There's R&D grants, there's salary grants, there's SHRED refundable tax credits. There's all these different things that can be tapped into. So that's also key, right? Understand what the landscape is for non-dilutive funding. And there's a lot of information out there on the internet to do that, right? And sometimes it's a matter of information overload. So again, it's knowing the stakeholders, knowing the folks at these organizations, having discussions with them, and sort of talking through what you're working on and seeing if they have anything that gets slot in to support some of that fundraising. Revenue data. So again, going back to that example of a financial model where we built up that 7-year forecast, let's say. So part of what has to happen in these early days is that market study. I don't know if anyone's kind of gone through that process quite yet, but there are consulting firms out there that will take a look at, okay, what's your technology? What's the market size look like? What's the market share that we could realistically go after? All really good assumptions to go into and say, well, if you're developing a technology that has rapid scalability potential, what do we think that market size is? What do we think the market share that's up for grabs could be? And what do we think the pricing could be, right? So looking at pricing of what you have, a lot of it comes down to early days is people know what their competitors are charging. They know what folks in the similar industry are charging. They know what let's say a medical device would cost. They know what's a monthly subscription price for this kind of deliverable would look like. So there's a lot of different ways you're going to think through what could be the revenue potential for your company, your venture, right? And again, a lot of this stuff can be really pie in the sky, or it can be really focused, and that can be done through like an official, market study. So a lot of times in startups, one of our biggest costs is our people. So looking at wages, oftentimes, I see a lot of startups where wages make up 85 to 90% of what our total cost is. So for that, obviously in tech and other industries as well. But in tech, tech salaries are kind of a specific beast all on their own, right? They have a lot of different nuances to them and a lot of comparable, figures out there. A lot of the big tech companies will pay, pretty exorbitant salaries for certain folks, right? So it could be a challenge to sort of figure, okay, what can we attract the right talent into our organization for, and what do we have to pay them to be able to do that? A number of different ways. I've seen a lot of clients where we kind of said, well, what can we afford now, right? So what can we afford in the early days to just pay you, and hopefully our employees and then folks that we're approaching kind of buy into that concept of what the company can do. I find that as startups mature through those early fundraising days, it starts to become a bit more, employees run out of a bit of patience maybe, and then they want to say, well, for what I'm doing, my market worth is X. So that there are firms out there that'll do actual salary analysis. They'll look at your industry, they'll look at how much money you've raised, they'll look at kind of percentile, assigning a percentile to your team and saying, for similar folks in Canada and North America, this is kind of what their comp is like, and this is what they need to get paid. And then it kind of comes down to, okay, what percentile are we really shooting for at this stage? And that can give you some good data to really forecast out what you expect to pay your folks. Yeah. Overheads, I mean, that should be the easy one, right? This is kind of what you're leasing your space for. What do you currently subscribe to for software? What do we expect to kind of run the office, right? Those kinds of things, again, probably fairly easy to pull those together. A lot of information out there on the internet, a lot of information from specific vendors and suppliers that you're working with. They can provide you with those numbers and those quotes. A big one obviously is if you're, let's say, a device manufacturer and you use contract manufacturing. A lot of folks will do that. Let's say if they're manufacturing a device, those contract manufacturing firms sometimes can be involved for years in discussions to sort of talk through, well, here's what it would cost for us to build this for you. And so that kind of can feed into, okay, what are our margins look like in the future, right? So a lot of different ways to get your assumptions. I just think it sort of comes down to, okay, well, you have to look at it systematically and say, well, here's what we expect to spend and who's going to supply that to us and what's it going to cost. Okay. And yeah, you'll never be 100% correct, right? It's always going to be wrong. So this one we've touched on before, right? So this is looking at details. We want detailed schedules. We want to list out everything. We want to have it reconcile out to what our closing bank balance would be. We want to be able to summarize and condense that information for various stakeholders as well. So it's kind of a summary statement on everything we've talked about there. Next few slides are just some quick examples. Just wanted to kind of show, like, how we approach building schedules. So a lot of times, we don't get fancy with it. We just use Microsoft Excel. So it really comes down to just listing things out in this kind of detail, right? So do we expect to close on a round of safe notes in October? Expect to raise $1 million? Let's drop it in, right? Do we expect that we can access some government money, right? So I just put IRAP in there as an example grant that this hypothetical company would be accessing. So we list it out and say specifically, this is the IRAP grant, right? Because sometimes those grants can start with a certain level of funding. And then as you continue through development, that can change. It can change significantly. So you want to be able to run, okay, well, you have an update to our grant revenue forecast because we've now been able to get through more employees eligible to receive that salary grant. Let's make sure that we can update that specific grant and know that that's kind of what we're expecting to get from government support. And then I always like to reconcile that down to total inflows, right? Obviously, we've got investment money, so we've got safe notes. That's a balance sheet account. Effectively it's a liability until it gets converted. And then we've got grant revenue, right? So that's revenue. The two together, that's kind of what we're expecting to come into the bank account. Sorry, it's probably really tiny. This is just an example of how detailed we would get when it comes down to looking at expenses, right? So looking at employees, what I've got listed here is specific employees and what their actual wage cost is going to be. We've also got a number of placeholder spots there where we can easily quickly drop in future hires, right? I always like to make sure we leave some room to add for changes as we go. So in this particular case, if you had a new employee that was going to start, you would just take that future hire, you drop in when they expect to start and what their cost would be for their employment. But this is the level of detail that we definitely like to kind of go from. So going back to the scenarios here. So in this hypothetical example that I've been showing, what we have here is effectively two scenarios that we can run side by side. So scenario A assumes a $1 million raise, and it assumes that we're working on a milestone that we want to complete around this October-November mark. We've got cash that's going to run out in April, right? So a bit less than what our buffer would be, right? We expect to be negative by April 2025. Scenario B would assume, the same opening cash balance, but instead of raising $1 million, we can raise 2, right? And so that's where you might look at saying, well, we want to condense milestone A and B together so that we can really advance the value of the company over that time period. And then what you would do is sort of in parallel, you would forecast out what do we expect our spend to look like, right? So this would be a higher inflated raise scenario, but also a higher inflated spend scenario, right? And again, I like to look at these two side by side. Forms a very a good discussion with management as we go. Oftentimes you'll find an inflection point where, during the fundraise, we weren't able to raise the 2. So then we have a discussion around, okay, well, now we're just pivoting and focusing more on scenario A, right? So these are good hypotheticals, and it sort of helps support, well, the what if scenario as to what we could bring in, what we could do. But obviously a lot of it's dependent on, where's the money going to come from, right? But just from a management perspective, we'd like to have scenarios that we look at side by side. And what drives these two scenarios is really just two copies of our schedules, right? So we have two scenarios running side by side with different expense profiles within them. So what we also like to do is we like to sort of map out and visualize through charts, like I kind of just showed the cash chart up above. What we're showing here basically is scenario A, scenario B, and looking at what our spend is going to be, right? So there will be different scenarios where we expect to have more spend, right? So under scenario B, we expect that there's going to be a larger emphasis on a consulting project, let's say in August of 2023. And we expect there to be further spend on another consulting project in May of 2024. Right? And again, it's really just sort of saying, well, if we were to raise that additional $1 million, here's how it would get deployed and advances towards that milestone. But if I'm looking at the two visually side by side, it's good because you get an order of magnitude as to where the cash is going to go. And then this is commonly, if we're looking at a slide in a board deck or something like that, if we're having discussions, let's say we're open in a round right now today, going back to that kind of granularity spectrum. This is ultimately kind of what a board would like to see on a periodic basis, right? Okay, what are we actually going to be able to raise out of these two scenarios? Where's the money going to go, right? So you can kind of see here, scenario A to scenario B, 868 under scenario A, 1.388 under scenario B. So we're going to be hiring a lot more people to get that milestone achieved, right? And so this guides really good discussions at the board level. Your advisors oftentimes will be able to really help and sort of say, well, yes, we think milestone 2 is going to really advance the value of the company when we get to the end of that time period. We should push for and strike while the iron's hot and fundraise to push to get $2 million, because I think if we run with this scenario, we'll be in a much better spot. Again, it kind of depends on what you can actually close and what you can bring in, right? So these kind of discussions are really really useful at the advisor level.
Yeah, I really like this. A very simple snapshot of the milestones looking next to each other. Like the details sometimes can blur the truth, right? Like, let's take a look here. Let me simply understand the difference in these two models. Like, yeah, I do want the details, but I do need a simple snapshot as well.
Exactly. Yeah. And the board doesn't want to see, they don't want to see these charts, right? They want to look at the concise, summarized information so that you can have high-level discussions around what's our strategy, what are we going to raise, who can we talk to about raising potentially more money, and those kinds of things, right? Oh, we are at 10:53. I just realized. So we go through KPIs and startups. So cash burn. So cash burn really, it's a dollar figure, right? It's what do we expect to actually spend on a monthly basis? So if you look here, I've got net burn. So what this is an average cash burn over the forecast period. And forecast periods are kind of a funny thing. We look at it differently from a fiscal year. We look at it more so from what's the cash out date, right? So when we do a fundraise, our reporting period might be 24 months, might be 18 months. And really what this is telling us here is this is what we're going to spend every month, 54 grand. Under scenario B, 82,242, right? So it's cash burn. That's a really important KPI to look at month to month. What was our spend? What was our cash burn? And what do we think it was going to be? Because that can have big implications as to what we expect this this runway to look like, right? So runway typically is another one that we look at a lot. Runway really focuses on how many months of cash do we have in the bank account. When I look at this on a net cash burn, so that includes, let's say, some of that grant revenue that you bring in. What's our net cash burn? What's our runway? And how many months do we have basically until our cash is zero? Forecast to actual, so that's a big one. So again, that's sort of making sure that we look at what do we expect that was going to happen and what actually did transpire in the month. Very telling in terms of what we think we might need to pivot or change in our model. As you start to get revenue generated, just looking at what our sales were is really a big one. Let's say you're a SaaS company, looking at that number is good. And specifically to SaaS, right, there's a lot of specific metrics there around monthly recurring revenue and annual recurring revenue. So those are big ones as well, right? So if we think about annualizing monthly recurring revenue, if your sales were 10 grand this month and they're all locked in on a monthly subscription service, well, your annualized recurring revenue is 120, right? So looking at that, it's a good metric to track because it kind of tells you what your annualized revenue numbers are at any given point in time. Yeah. These are just kind of a snapshot of a few KPIs that we definitely focus on, especially early days. That that kind of runs me through my slides. I know we're down to the wire here, so
yeah, okay. Well, that was super. That was great. I mean, I'm a geek about a lot of things. I'm a geek about financials and financial models as well. A couple startup focused questions that, yeah, we don't have a lot of time. But I do have a couple that I think is important. But you can correct me if I'm wrong. That maybe didn't have enough time to elaborate on that much. So what are some of the mistakes in financial modeling that startups do, and how can they avoid them? And one I want you to, if you could address for me specifically, like, I know liabilities, like actually putting a line in for risks and liabilities, and sometimes like severance liability. Like if things don't go the way I'm planning, like, do I have the runway I think I have? Like that's, I think, an important one. I know the oil industry got into this trouble with like abandonment liabilities and not reporting them correctly a few years ago. Like for startups and like a lot of people who've never thought about this, like, can you maybe give some tips or some advice here?
Yeah, no, for sure. And I think the key one there is that's why we come up with this sort of buffer. Like the accountant in me hates sort of just saying, let's account for this additional 15% overage in terms of our spend. And, but realistically, what that's designed to do is to catch those sort of unforeseen situations that come up in the future. We work with startups all the time where, that maybe the modeling wasn't done with as much diligence as it should have been. And we find ourselves in a situation where we haven't completed what we needed to complete with our milestone because we didn't forecast it out. So now we're looking at doing a bridge round or something like that to just bring in some capital. And it's a bit more difficult to justify a bridge round because we don't really have anything to show yet for it. So really, it comes down to is plan for the buffer, right? Plan to make sure that you're aware that there's going to be additional expenditures and spend. And that's why I like 6 months. It's a long period of time. But for the most part, I find that, by the time you get to the end of that timeline, you're probably going to be closer to like your amount of forecast costs plus buffer. Yeah, that's a big one, right? We don't want to find ourselves in a situation with cash flow, right? Mature companies and startups, same thing. Cash really is king, right?
Yeah. Okay. And so that's another one, right? So there's is it the innovator's dilemma or something, like developing with cash flow? I mean, can you tell me how you balance that need to invest in growth with the need to maintain profitability in a financial model for startup? Maybe elaborate on that.
Yeah, for sure. I mean, I think, you think about growth. So anytime you invest in growth, there's going to be a hit to profitability, right? You've got to staff up, you got to bring the right people in-house. But I think, my advice there is you've got to show a longer term period where you can say, this is our growth phase. This is where we expect our profit and our margins to really be invested in growing and scaling the company. And here's how we expect to get that economies of scale when we come out the other side of it. We've got the team that we need to have, we've got the software and technology that we needed to have, and everything's kind of put together. But I find that the longer term forecast there is really necessary, right? To show, a bit of pain as we grow, but as we come out the other side of it, here's where I expect to start really seeing the return for that investment.
So I want to open up to the floor, but we are at 10:59. So I'm going to ask one question, and then if we can stay on a few minutes, I know people are going to have to leave. But if you were going to recommend one book or one resource to startup founders, like if you're going to read one thing, like here's the resource that you should think, this is what you need to know, in a nutshell, in a condensed.
This is actually a great book here. It's called Scaling Up. I don't know if anyone's read it there, but it's got a lot of really good practical tips as to how to actually account, like how to deal with cash flow as you're scaling up and growing. This is a book. Oh, you got it. Yeah, this is a book I open up and I read through chapters all the time because it's actually a really good read. So I'd recommend pick this up on Amazon or where we can find it. But it's actually, it's very insightful. Yeah.
Okay, I'm going to quickly Google that. It's Vern Harnish, Scaling Up. It's fantastic. And actually, I don't know if you know this one, even shorter, but building on this material, and he wrote the foreword. There's a consultant out of Vancouver who's a former founder, Exeter, named Shannon Byrne-Cisco. And she's written 3 books called The Metronome Effect and The 3-Hag Way. And it condenses some of this material and makes it a lot more operational, in my opinion. So that's another one for you if you haven't heard that one. I'm going to add those in the chat. Anyone else have any questions here for Nick? Nick, we're going to add your contact information and LinkedIn in the chat as well here. Anyone interested? Some finance questions? I'm going to say thank you, but I guess I'll close it there. We're at 11:01. We're on the hour here. If there's no more questions, I'll shut off the recording. We can stop, and we can stay a little longer and chat. But I think big thank you to Nick for having me. For the session. I think that was super for me, it's super interesting and super useful, I think, for everyone. So thanks a lot, guys. I will, again, I'll find those links of the books in the chat. I'll throw them in here after we end the recording. Thanks a lot, guys.
Thank you so much, everyone.
Okay, I gotta Google this book. That's great. And I'm glad you picked that book. I love that book.
It's a good one. Yeah, for sure.
It's a great one. It's super useful. And I find I'm always showing people. But yeah, the
Got a
three
lot of
head,
practical tips. Yeah.
the metronome effect and the three-head way, she built on
I'm
a
gonna
lot
have
of
to read. I haven't read that one, so I'll have to take a look.
she exited a few or she exited at least one, I think 2 companies in the 90s. She's actually Whistler based, and I think she does a lot of advisory to Vancouver based tech companies, actually, and not accounting advisor. She's a CEO, company builder. But here, let's just see the scaling up by Vern Harnish. That was awesome. Yeah, that was really a great session. Thank you so much.
Yeah, no, thanks for having me. Yeah, that was great. And yeah, if anyone reaches out to me, email or LinkedIn, I'd be happy to.
We will share with we will share, obviously we're going to email the recording, your contact information, everything out to the people who participated. I will make sure like all of our summit participants get that as well. But yeah, we'll share the recording, and then yeah, I'm trying to think what else is. Angela's not on the call anymore, but
He's dropped off. Yeah,
we'll definitely make sure we'll capture the attendees and make sure they all get your contact info.
awesome. Thanks, Adrian.
Cool. No problem. So people aren't here anymore, but I'm going to still share the book in the chat. There we go. For anyone who is here. Thanks a lot.
Yeah, thank you.
Thank you, Adrian. Thank you, Nick. Appreciate it.
Thank you so much.